You clicked because you saw the headline about record-breaking credit card debt and felt a knot in your stomach. You are wondering if you are doing something wrong or if the economy is collapsing around you. That fear is natural, but the story behind that number is not what you think. By the end of this, you will understand why this surge is actually a signal of consumer confidence and how it creates a unique opportunity for you to position your finances strategically. For years, we have been told that credit card debt is a sign of financial failure. We are taught that every dollar charged on plastic is a dollar of weakness, a sign that we are living beyond our means. But when the Federal Reserve and news outlets announce that credit card debt has hit an all-time high of $1.21 trillion, the immediate reaction is panic. We assume this means everyone is drowning in obligation and that the system is on the verge of collapse. That narrative is incomplete and, in many ways, misleading. The reality is far more complex and offers a different path forward for anyone holding a balance right now. Here is the thing that most financial commentary misses. This surge in borrowing is not a random explosion of bad habits. It is a robust signal of consumer confidence. Think of the economy as a massive machine where borrowing is the fuel that keeps the gears turning. When households decide to take on more debt, they are essentially betting on their future income. They are saying, "I believe I will be able to pay this back." This behavior mirrors a strong positive correlation between borrowing surges and overall economic expansion. When people feel secure enough to leverage credit despite inflation and higher interest rates, it tells us that optimism is currently outweighing immediate economic anxieties. Now consider this. We often treat debt as a static number, a simple sum of money owed. But the data reveals that the structure of this debt has changed. The record figure is structurally distorted by the inclusion of fraudulent transactions and charge-offs that are often delayed in reporting. This means the active default risk is lower than the headline suggests. When you see that $1.21 trillion number, you are seeing a lagging metric that includes old problems being cleaned up slowly. It does not mean that the average person is currently at the breaking point. The surge is driven by a shift in transaction velocity and average ticket size rather than a fundamental change in borrower creditworthiness. Quick resource note. I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. This leads us to a critical insight about how the system is actually working right now. Banks are currently incentivized to maintain high utilization rates because that is how they generate fee revenue. In a contractionary market where everyone is cutting back, banks would be desperate to collect every penny. But in this current environment, they need you to carry a balance to keep their business models healthy. This creates a temporary buffer where aggressive negotiation for lower annual percentage rates or balance transfers is more likely to succeed than in a downturn. The position of power has shifted slightly toward the debtor because the lender needs the revenue stream to remain active. We also need to look at how credit scoring models are evolving. There is a major architectural shift happening behind the scenes. Automated systems are increasingly prioritizing real-time behavioral signals over static debt-to-income ratios. This means that individuals with high balances but consistent repayment velocity are being treated as low-risk assets by these algorithms. The label of high debt is being decoupled from the label of high risk for those who manage their payments well. If you have been making on-time payments despite carrying a balance, the system is likely recognizing your reliability even if the headline number looks scary. This brings us to the most important part of this entire discussion. The Federal Reserve watches these debt levels closely as a leading indicator for interest rate cuts. The current all-time high reflects a lagging confidence metric where borrowers are leveraging previous low rates to sustain consumption despite inflation. This signals a potential inflection point for liquidity. When the data shows that consumers are confident enough to borrow at these levels, it suggests that the economy is ready to absorb a shift in monetary policy. The panic you feel is based on the assumption that this debt is unsustainable. The data suggests it is sustainable for now, but it is fragile. The University of Michigan Sentiment Index recently dropped to 50.8, indicating that this confidence is not without its cracks. The surge follows a period of deleveraging, implying that current borrowing may be a delayed reaction to prior lockdowns rather than pure optimism. We are seeing a complex interplay where households are finally feeling comfortable enough to spend again after years of restraint. However, Unmanaged balances still pose severe risks to individual health and credit scores. The systemic opportunity does not erase the personal danger of carrying high-interest debt without a plan. The lack of granular data on specific interest rate sensitivity in this high-rate environment leaves a gap in understanding how long this confidence can sustain itself. We do not know exactly when the correction will force a shift back to deleveraging. But for now, the strategy is not to panic. The strategy is to recognize that the market conditions favor negotiation and that your creditworthiness is being judged differently than before. You are not failing because you are carrying debt. You are participating in a cycle of economic expansion that is currently driving these numbers. So, how do you use this information? You stop viewing the headline as a personal indictment. You view it as a market signal. You recognize that banks are more willing to work with you now than they were in a recession. You understand that your consistent payment history is being valued more highly by automated systems. This shifts your mindset from fear to strategic positioning. You can approach your creditors with the knowledge that they have an incentive to keep you as a customer. You can plan your financial moves with the understanding that the economy is currently in a phase of confidence, even if that confidence is fragile. The key is to stop reacting to the panic and start reacting to the data. The $1.21 trillion is not a death sentence for the economy or for your personal finances. It is a snapshot of a moment where optimism and consumption are driving growth. By understanding the mechanics behind the number, you can navigate this period with clarity and confidence. You can make decisions based on the reality of the market rather than the fear of the headline. This is your moment to take control, not by avoiding debt, but by understanding the power dynamics that currently surround it. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.